Welcome to Sharing Mindsets, the go-to podcast for everything real estate in your region.
All right. We are going live here at the Daryl King team on Yonge Street with my good sharing of the mindsets with my good guest, Dion Beg. And I'll tell you what, this guy, there's a lot of people, but he's built up a reputation for him and his company like no other. So I'm honored to have this distinguished guest, Dion, a titan in the mortgage industry and the innovative mind behind Kanga Mortgage. I love the name, Kanga Mortgage. With over 16 years of expertise in property and finance, Dion has facilitated hundreds of real estate transactions. That's probably thousands, right? Ranging from first-time home purchasers to building robust investment portfolios. Under his leadership, Kanga Mortgage has become a beacon of excellence. Boasting a team with 60 years of combined experience, their dedication and exceptional service have earned them the Consumer Choice Award and a consistent ranking in the CMP Top 75 Brokers in Canada for 5 consecutive years. So, big hand for you for there, my friend. Thanks, right? So today we're going to explore the intricate world of mortgages, guided by Dion's vast experience and insight. We'll uncover the strategies that have propelled him and his clients to success, learn how to navigate the industry's toughest challenges, and gain exclusive knowledge on mastering the real estate and mortgages landscapes. So the episode is an invaluable resource for anyone looking to either enter the industry or elevate their current position in the real estate market. So whether you're a real estate agent, a homeowner, a buyer, a seller, or an investor, the episode holds the keys to unlocking your potential in the ever-evolving world of real estate and mortgages. So I'd like to welcome Dion.
Thanks again.
And let's give him a big hand, everybody.
Okay.
Thanks for everybody being here live today. We've got some here live, but most are on Zoom today. We just had our awards banquet last week, and that was a very huge success. We had an awful lot of fun. So I'm really happy to be here with you today to share your insights and your wisdom. So let me ask you, start from your humble beginnings. How did you become, of all things, a mortgage broker?
Sure. So I'll go back a little further. So my background is I was actually born in Fiji, the small
beautiful place. You haven't been there.
Right.
Put on your bucket list.
Yeah. And then I graduated. I moved to Australia with my family.
Another bucket list.
Right. So I'm actually Australian. That's my citizenship. That's why the name of the company is Kanga Mortgage, because people remember animals, I think, more so than they remember most things. But I graduated university with a degree in international business. I went and worked in Japan for a couple of years because I speak Japanese. And then how
many languages do you speak?
Just English and Japanese.
Okay.
Yeah. But then when I returned to Australia after my time in Japan, I'd actually bought a property in Australia while I was in Japan. And I came back to Australia and I'd saved $20,000 cash. And I thought that was amazing. But the house that I purchased had gone up by about $80,000.
So you saved 20 while you're away working.
Correct, yep.
But you have a good substantial deposit, going to be easy.
Yes.
And meanwhile, the market took off.
Correct.
And raised by $80,000.
Yeah. And so I said to myself at that point, I'm like, if I worked for 4 years and was only able to save 20 grand versus this house increasing by 4 times that number, I said, you know what, this thing, real estate, warrants a little bit of exploration, right? So I really got into the world of investing, and with that, I decided if I'm going to learn this industry, I should actually get educated and get licensed. And so I actually got my license as a realtor in Australia, and I coupled that with a license in financial planning. And so I ended up working for a small boutique real estate agency that did real estate planning and portfolio planning, wealth creation, debt pay down, but using real estate as the tool rather than using mutual funds and shares. So I got that very early exposure to real estate. I was around 24 years old at that time. And then after that, I moved to Canada. I met my Canadian wife, moved to Canada. That was 2008. Probably the worst time in the world to be in the world of finance or real estate.
No doubt.
Anything like that.
If anyone can remember, 2008 was the great crash, and North America got beat up pretty bad.
Totally.
Right?
So global financial crisis, moved to Canada. And what I learned in my early stages in Australia is that financing is usually the key to success in real estate. If you can get the financing, then you can build these portfolios. And so when I came here, I said, let me start in mortgages in Canada with the potential view to become a realtor later on. And as it turned out, I really enjoyed the mortgage process, and I built a team and I built systems which have now allowed us to effectively, reach the heights that we have. Help. We've now funded over $1 billion in mortgages in Canada.
$1 billion, eh? That's a couple shekels. So the funny thing is, I started in my early 20s also, right? And it's something, if you find a passion for what you really like, it's not work. It's being your creative self, and the creative juices come out of you, right? Because you're always looking for a solution. And that's how I started. I always, I know there's problems. Interest rates were 21%.
Oh, yeah.
And people are talking about 5 and 6%, and it's like the end of the earth. So how about 21%? That was the end of the earth. I don't think there was anywhere else to go, right? So, you realize finances was the solution. And, so me, I had my mortgage broker license.
Right.
But it almost became a conflict of interest. I can't serve as a real estate and then be giving them financing because there is conflicts there. So, I gave that up. I was going to have half real estate, half mortgage. So now I let the professionals handle that part, and us guys will handle the other part, right?
Yeah. I feel like specialization is really important, especially when you're trying to guide somebody through their biggest decisions in life. It's hard to be everything to everybody, and I agree.
Yeah. So what would be your philosophy or core values have guided you and your team to success in the competitive mortgage landscape?
Yeah, so everybody says this, but we really truly believe we practice it, which is put the customer first and also figure out a way to provide a lifetime value to the client. So our business, Daryl, is one where a lot of people in our industry are very transactional focused. It's just like, get this transaction and move on to the next.
That's the problem, right?
Right. And so when we got into this business, and with a background in financial planning, and having understood that, throughout the course of a person's life, they're going to need different things, I tried to figure out how can my business serve this person throughout their lifetime. And so for any professional listing, it's figuring out your lifetime value to your client, right? And for us, it breaks down into 4 separate sections. It's buy your first home, get debt-free, set up your kids, and set up your retirement. These are the 4 things which we've built our business around. And so rather than just build ourselves as a mortgage team, what we are the solutions to the biggest financial problems that clients will face in their lives, or movement towards their biggest goals, right? And so as positioning that way, when a client deals with us, that first transaction, we make it very clear to them that will not be their last, and that our job is to be beside them every year with their annual updates, making sure that they're on track. We check their equity positions. We figure out how we can help them move up and or buy that cottage or buy that investment property.
So, like most people, everybody wants to start with the castle, right? They don't realize, especially you said you saved $20,000. Meanwhile, the market had went up 80,000, so you only fell behind by 60,000. And what happens is that you got to save strategically.
Yes.
And the purpose. So today, I remember I bought my first house, I think about 21, 22. And I had to save up for a mortgage. I bought a brand new house. So I had the down deposit. Wasn't closing for 9 months later. So it gave me an opportunity to just go work like a horse and make some extra money to bring that mortgage down.
Right.
Now that mortgage back then, I think was $90,000.
Okay.
Right? Today some of these mortgages, $700,000.
Of course, yeah.
Mortgage, but incomes are different. So what would you tell like a first-time buyer, like understanding mortgages for a different clientele? For first-time home buyers feeling overwhelmed by the mortgage process, what simplified advice would you offer to demystify it?
Yeah.
Because, today, when like I say, I know of a young couple, one of the agents called me up from one of the other offices on Friday night. We talked for about an hour and a half. That was like 11 o'clock to about 1:30 in the morning. and this young couple bought a property for $930,000, and that's including the upgrades. It's a freehold townhouse, double car garage, finished basement, and I think they had $180,000 into it. They got to come up with another $70,000 to close it, which they really don't have now, and then to carry it's going to be about $7,000 a month.
Is this a pre-construction?
Yes.
Right.
Right?
Yeah, we're facing a lot of these, those particular issues right now, because when people sign for pre-construction, unfortunately, they don't plan for multiple exit strategies, right? A lot of people who bought pre-construction have only one exit strategy, and that is sell it and or assign it for a higher price. But the challenge there is you can never guess what that market is going to be 3, 4, 5 years from when you sign that purchase agreement. And so, unfortunately, they were one of the speculators by the sounds of it.
Why not?
Right?
Well, I think they were going to be end users, but what's happened is because, when they were going to get the mortgage was around, 1% to 2%.
Sure.
So now the mortgage is up quite a bit higher.
Yeah.
So the mortgage cost is too high for them,
Right.
right? So, and, people think, the builder should give back the money. Now, I see one of the builders is just coming out, Aspen Ridge, as a matter of fact, is doing this. They're giving you a guarantee if the market shrinks, they'll give you a shrinking.
Is that right?
Yeah.
Okay, I haven't seen that. But
yeah, it just came out, so it's hats off to them. But what's the difference? Well, if someone, and the way they, most realtors, 92% of the realtors only know from a good market, and I can pretty much say most of the mortgage brokers, 92% only know for a good market. So they just thought, money will just come easy. It just will keep growing and growing and growing. They've never seen the highs and then the changes. So people like yourself and myself, we've seen this numerous times. So, there's no sure thing. You're going to hold something for 10 years, you're going to make money if you do it in the right 10 years. But, like you said, to get the financing to start is the most critical part. Get your foot in the door, open the door, so they got to start smaller to get into that door.
yeah, so it sounds like maybe these guys bit off a little more than they could chew.
That's what I'm seeing.
But I'll answer the 2 parts here. So for that specific client that bought that property, we've had similar situations this year, as you can imagine. People purchasing 3-4 years ago based on interest rates 3-4 years ago. And what we've had to do is figure out how to raise this capital. And it's not just what you have, but it's also your network. Meaning, in many cases, we're leaning on family, in particular, parents. And a lot of these parents will help if they can just get the sort of, if they can understand what a cosigner is and the consequences of reaching into their own equity to give their children that extra, say, 70 grand that you mentioned. So it's very funny to say this, Daryl, but in the last year in particular, we haven't just been mortgage brokers. We've been like family counselors and estate planners. We've had to get lawyers and wills readjusted and those types of things so that if the parents are giving money to this child, but that second child isn't yet buying, how do they make allowances for that? So I think in our business, we end up doing the job of other professionals, or at least pulling them together so that we can make these very difficult situations come together.
Well, that's a good point because, everybody says we're all competition with each other. Guys, we're in competition with nobody. You're in collaboration with everybody. And that's why, I feel a lot of small people-minded think that way, that there always seems to be in competition. And the competition is really within yourself. If you go do what you're supposed to do every single day, you'll be successful. But if you don't do what you're going to do every single day, you'll be a failure, and you can't help people. And in your business and my business, we have to work in collaboration.
100%.
We have to have a great mortgage broker team, and we have to have bankers, whoever, and they have to have great real estate agents, and we have to have great lawyers. So sometimes stagers and handy people. So we all have to work together. And the problem is that sometimes they get those things crossed up, that they don't realize they're working as a partner to help each other out. And the more they understand that, the easier it is. So, I have certain lawyers, certain mortgage people that we like to use, stagers and everything else, because we know they're going to perform a professional job and get it done properly. So, if you get more people like that and more, you're going to go up to AREA this week So he's going to be up to Aria this week. He's one of the main speakers. So we got him here live. So come in, right? You know. But they're looking for someone with knowledge that can share that. You know, it was funny. We were at, Kathleen Black's event?
That's right.
And he shows me an event with me 10 years earlier.
That's right, yeah.
At Rob Vivian sitting in the front seat.
That's right.
That's how far back. We go further than back. But, you know, the ties are intertwined. And you have to keep working those things. Networking is so important that always learning to find partners in the mortgage industry as along with the real estate industry, right? So how does the approach differ from dealing with a seasoned investor versus first-time buyers in terms of mortgage planning and execution?
Yeah, no, this is a great question. So, I mean, like probably like your business, a lot of our business are first-time buyers and investors. So the first-time buyer is really focused on affordability, as you can imagine. Affordability is a real big issue right now with the monthly cost of those mortgage payments. And so one of the first things we have to sit down and with our first-time home buyers and discuss is that monthly payment, right? Everybody wants to get out there and buy that house, but we've first got to start with that monthly, right? And then we reverse engineer from there what is the purchase price and, you know, the down payment required. So for anybody listening, the simple thing with mortgages is when you're buying, there's three things that banks look for, and they are credit, income, and down payment, right? And if you are strong in all three, you're generally going to qualify with most lenders. If you're weak in one, you better be very strong in the other two. And so So
which one is the most important one?
So when it comes to first-time home buyers, you know, it's hard to say, Daryl, but I will say this: credit is likely the most important, because credit then determines what kind of a down payment you may or may not qualify for. In some cases, if your credit's not great, you will need 20% down. If your credit is above a minimum threshold, then you'll be able to qualify for, you know.
So when they talk about credit, they generally talk about credit score, right?
Yes. Yep.
So how does one go about and get their credit score up? Because, you know, like everybody, sometimes the bills come in and they're late paying a bill. Every time they're late paying a bill, it goes against your credit score.
Yep.
Right? So talk about that. Because I think people really need to understand credit score. Because, you know, some people go buy a house and then they're going to go buy a car.
Yes.
Right? It's like, you know, as realtors, guys, we got to go tell them not to go buy anything when they're buying a house. That's so important. So explain that.
So on that point, you know, there's this old saying, you put the cart before the horse. In my business, I say, don't put the car before the house, right?
Yes.
Because so many people, guys, will go out there and buy that beautiful car and not realize the impact that that's going to have on their ability to buy a house. And the funny thing is, the reverse is not exactly the same, meaning you could go buy a beautiful house today, and the very next day you could walk in a car dealership and likely still get that car. Right, at a reasonable interest.
Because now you got the equity of the house to back you up.
Yeah, but also that monthly payment doesn't count negatively in the same way against you as a car payment will count against you when you're buying that house. So please remember that. And if you've got clients out there who are thinking of upgrading their vehicles, I always tell all of my clients, like especially once they've onboarded, especially if they're investors, before you make any major purchases and you're committing to a monthly payment, call me, right? I need to know what that number is going to be, because that might impact the projections of that, you know, that next investment purchase that we had planned out last month, right? But in terms of credit, okay, everybody knows, you know, you should pay your credit on time. That's pretty straightforward. What some people don't realize is that the gap between your credit limit and your credit utilization also plays a very big factor. So, for example, let's say you got a credit card with a $10,000 limit, and you utilize that card to $9,900, I guarantee you that's going to negatively impact your credit score, okay? So if you want to be very strict about it, you probably want to utilize maybe only 30% of that number. For me,
30% of your credit card?
Correct, if you want to be super strict about it. I'm not so worried about that now. This is for people with new credit. This demonstrates to the bank that I have access to credit, but I don't need it. Who do banks love giving credit to? People who don't need credit. Exactly. It sounds insane, right? And the way you demonstrate that, guys, is you say, I've got these credit facilities, but I don't even need them, right? And I'm being a little bit overly cautious there, but for me now, the other next thing is multiple credit cards, most people think that having multiple credit cards is a bad thing. In my experience, it's in fact the exact opposite, right? So if you have one credit card and you happen to have a hiccup on that credit card, 100% of your credit rating is impacted.
By the one card.
But if you had 5 credit cards, right, and one of them screws up, yes, it's going to impact you, but the fact that you can show that these other credit cards weren't impacted, that type of scenario has helped me significantly when going in bat for a client who maybe was overseas, had a medical issue, and had a hiccup on one credit card. So it's width of credit and depth of credit is important, right? Student loans and mortgages, while they report to the credit bureau as as facilities, they don't have the same positive impact on producing a credit score than consumer credit does. So credit cards, unsecured lines of credit, they're the ones that have the most positive impact. Car loans, yes, they have an impact because it's secured, the impact is not as great as those unsecured facilities. So my advice to anybody who is planning on buying a year from now is actually to go get a couple of credit cards now. This will have a short-term negative impact on your credit rating, short-term, right? But 12 months from now, once you've got, say, 3 or 4 credit cards, and you've boosted and you show, hey, look, I've got all this access, but I only use a little bit, that will actually positively benefit you. So if you're in the middle of buying, if you're thinking of buying in the next 6 months, do not do this. But if you're thinking 12 months out, or if you guys are talking to your clients about how to build that credit score, the time to get it is when you're not actively buying. It's at least, I would say, in my opinion, about a year out from that, or earlier, ideally.
So credit cards, guys, they actually help you if you use it correctly, right? Most people think it is a negative way of getting money, but if you're showing that you're paying off, like those guys that don't have any credit cards that try to pay cash their whole life, and then all of a sudden now they're going to use a credit card, their credit scores are really very, very low.
And you've seen this too, Daryl. We deal with people from different ethnic backgrounds, and in certain ethnic backgrounds, credit is seen to be a demon, right? It's not something that you want to get, even if you can. But if you're in Canada and you want to buy a house and you've got to get onto the Canadian credit system, which means sometimes you've got to get those cards even though you don't want them, because you have them doesn't mean you have to use them. Most of my credit cards sit in in my sock drawer beside my bed. I don't even touch them, but I have them, right? I usually have 2 credit cards, one personal, one business. Yeah. I've got a bunch of others. I couldn't even tell you what they are, but they help me with my credit score.
So credit score. So I just... Working with a trusted lender is the best way to get more information on how to get your credit score and how it could factor into your home loan and the mortgage rate you're able to get, as FISCO says. Many lenders use credit scores like FISCO scores to help them make lending decisions. Each lender has its own strategy, including the level of risk it finds acceptable. There's no single cutoff score used by all lenders, and there are many additional factors that lenders may use to determine your actual interest rates. So, beside credit cards, what else would you say might be a factor in that?
In terms of credit itself?
Yes.
Like we discussed earlier, credit utilization, keeping away from the limits, and the type of credit cards too, guys. If you got the choice of getting a major bank credit card versus a store credit card, take the bank credit card. It just reports better. I'm not saying don't get one.
And you can buy more places with it.
Potentially.
Right.
And just understand that if you're taking on a loan for a car or something along those lines, the quick math, guys, is for about every $600. Let's say you have a $600 car payment, okay, which is not uncommon nowadays. In fact, I've seen many much higher than that. $600 car payment is equal to a $100,000 mortgage payment, ballpark. What does that mean? It means by having that $600 car payment, you've just reduced your mortgage borrowing power by $100,000. Okay, that's the direct impact of that car payment. Okay, so be aware of that.
So if you go get a new car like just months before, you've just cut your chances of like big time to get more money and to qualify.
Correct.
Right?
Yeah.
So this strategic insights and success stories, could you delve into a particular strategy or innovative solution that has been a game changer for your clients in securing mortgages?
Yeah, so, I mean, the thing that we try, as I said earlier, to do for our clients is build them a portfolio that serves them throughout their life. So beyond their first acquisition, we then try and figure out, okay, what's the next most important thing for them? And we figure out what their goals are, and then we reverse engineer. If you have kids, then probably for most of you, it'll be how do we set up your kids for their education. Also, in the last couple of years in particular, it's not just education. Smart parents realize now that the next 15 years of real estate will look very different from the last 15, meaning that getting their kid a good education and therefore a good job and good income is not enough anymore. We are actually figuring out a way for these parents to get enough equity so that they can write checks for 300 grand for their children so that they can get their children into the real estate market. So I know this is not the news that a lot of parents want to hear, but the truth is that if you're not ready and financially able to write those checks to your children, it's not likely that they're going to enter the real estate market in the same way that you did. And the same way that you did, which was just, a good income, good credit, good down payment, is not enough. So I'll give you this number here, Daryl. 100 grand, sounds like a lot of income. $100,000 income was enough for most people to buy properties up to, say, 5 years ago. Right now, guys, $100,000 household income gets you a borrowing of somewhere around $450,000 to maybe $500,000, depending on your situation. That means that a $200,000 income gets you around, $900K in mortgage borrowing power. So, regarding how are we helping people prepare for the future, it's having them get their head around that and knowing that even if their kids get good jobs, they're still going to probably have to help them through co-signing and or gifting, right? And how are we doing this, guys? For many years in our business, we've had what we call the 15-year, $2 million plan, okay? And I usually do this with a PowerPoint, but I think I'll be able to explain this pretty simply verbally. Guys, real estate, on average, in the GTA, has grown at over 6.5% a year, on average. We have good years, we have bad years, we have crazy years. We had years recently we were plus 20, and then
25%, yeah.
But when you
they should never be those years. They're years that should be erased out of the history books, because when you have that type of speed, it's not a true market, and way too many people get hurt. That's why we've been going through what we've been going through the last couple of years, because rates were so low, people were far exceeding their limits of what they could afford. And now with the changes in the mortgage rates, most people are feeling this.
Yeah. And so, just a quick note on that, guys. The next time you see the market run up the way you just saw it in the year 2022, refinance everything you have, okay? And the reason I say that is you get to capture the equity that exists in your property at that moment in time. You can secure your $500,000 or $1 million line of credit. And so when the market turns, you're the guy who's liquid and can go out and buy. We did this for most of our clients in the year 2022. While a lot of clients were buying, we were also helping clients refinance to capture their equity in lines of credit. And many of those clients right now, they're actually entering back into the market because, as we've discussed, the opportunities are coming. They're here now, and they'll continue to present.
Funny enough that you would say this, and this is a much bigger scale than most of us would ever work on. But I was talking to this builder that I sat with last night at the event, and, they looked at, I think, 64 projects, they told me, right? And they got it down to 2, and the one, didn't make through, but the one they got through is gone power of sale, basically, and it was $21 million. And they picked it up for under $15 million.
Right. Because they were liquid, right? Because they had liquidity.
Yes.
Guys, liquidity, and for the commission-based salesperson, which is everybody in this room, liquidity is key, right? We are going to have good years, we're going to have bad years. But if you can create for yourself a cushion, a safety net, an emergency fund, usually through your own personal home equity line of credit, this is the way that we've helped many of our investors, many of our realtor partners set themselves up for hard times like the times we've seen in the last year.
Yes.
Okay. But if I just get back to your question about how we're helping people in this $2 million plan, guys, as I mentioned earlier, this growth rate is at around 6.5%. We make our plans for our clients based on 5% growth, so even more conservative than the 50-year history. And at 5% growth, the number there is at 5% growth, house prices double every 15 years. Okay, this is an important number for you professionals to know. 5% growth, house prices double. It's actually 14.4 years. I just rounded up to 15. And so if we can get our client to buy one property, let's say today, for 500 grand, then, and everything runs according to plan, then that $500,000 property should be worth $1 million 15 years from now. Today, we could probably finance that 500 grand entirely because we're borrowing equity from property one and getting a mortgage on the subject property. And over time, that $500 mortgage gets paid down. Let's say in the same 15 years, Daryl, it'll get paid down to say 300 grand. So now in 15 years from now, we've got $1 million asset with a 300 grand debt load. We've got $700,000 of equity in one property. We get our clients on plans that help them, will show them how to buy 3 to 4 properties. If we can buy 3 properties that each contain 700 grand equity, we're at 2.1 million in net worth. And that is the plan that we've been assisting our clients roll out for so many years now. And the funny thing is, because we use conservative numbers, most of our clients are on track or have already exceeded that $2 million number before retirement. And, you know, I've got clients who are self-employed, so they have to go and create their own retirement plan. I have lots of clients who are realtors. They don't have RSPs. They have to go and create their own retirement plan. But I also have teachers. I have OPP police officers, and they're going to get great pensions. But I don't know anybody who wouldn't also like to have an additional $2 million when it comes to
especially
right?
especially the cost of retiring now is 30 to 40% higher than it was earlier.
Well,
right? Look at how many times people have set their table. They're going to retire at this level.
Usually that number was $1 million.
Yes.
$1 million, I can retire.
It'll
right?
be like, and today it's changed so
So
much.
BMO just did a survey of Canadians and asked
I read
them,
that article.
asked them, how long or how much money do you believe you're going to need to retire comfortably? And the majority of people came back with an average of 1.7 million, right? And that's why, we've got our clients on these path to 2 million. But at 1.7, the way they look at it, guys, is at 1.7, if that was just invested in a conservative mutual fund, throwing, say, 4% return, then you're going to make around 60 to 70 grand a year in passive income without diminishing the principal. But yeah, for me, I wouldn't want to just aim for 1.7. I'd want to go for 2-3 million if I'm out there trying to retire comfortably. Yeah.
Right. Well, a lot of people are not even thinking about retirement. They're just trying to save up for that first house. So what would you tell somebody at, let's say you're in your 20s, 25s, whatever, and, maybe you're single, maybe you're getting married, whatever. What would be some little tricks that they could find a way to save up some money? And because that's always the hardest thing.
Yeah.
The deposit, like you said.
Yeah.
You went out and made $20,000,
Yes.
and you thought you were on top of the globe,
exactly.
and then you found out you lost by 60,000, right?
Should've bought
So,
more property.
what we know today and what we didn't know yesterday, well, we may knew it yesterday, but we didn't act on it because, as young people, we'd sooner just go party and spend our money and have fun. I remember when I bought my first house, 21, 22, I was an oddity, like, why are you doing that right
Yeah,
after?
I bought mine at 21 as well.
Yeah.
Yeah.
So, people look at that and go, what do you. But
Sure. So what the advice for these first-time home buyers, like what to do? So a couple of perspectives here. Something interesting to note is just the way the world is today, most people aren't getting married as early as they used to, right? People used to marry at 25 years or younger. Now that number is pushing out to around 35, okay? Also, people are living at home longer and or sort of, having a roommate, share a condominium or share a house. What we're seeing is a lot of these people understanding that even though they're renting or living with family, that they should get into the real estate market, and then not necessarily having to buy their first home as their principal residence. We're seeing a lot of people actually take the first step into real estate ownership as property investment, right? So we're seeing, again, I try to find, or the type of clientele that I try to attract, Daryl, are what I call future-focused, big picture thinkers, right? People who can see beyond just tomorrow. And so because of that, I'm very fortunate to have attracted into our world people who are willing to help their children, okay? And so when their kids get of age, like the ages you're talking about, we sit down with everybody and we say, okay, what's the plan? Well, they're living at home and or they're living with friends or they're living with friends downtown in a condo, but we want to get them into real estate. Then mom and dad will gift them or partner with them to buy that investment property. and then they'll go off and over the next 10 years while they're living their life as a single person before, say, they get married, they get the opportunity to build, 2, 3, 400 grand in equity. So that the time when they want to buy their first home, they've actually planted the seed years before, and they have something to move forward with to get on the property ladder. So for those of you who are lucky enough to be able to approach this problem as a family unit, that would be the number one thing. And I know that, again, our country is full of immigrants. I'm one. A lot of people in this room are one, or children.
Pretty much everybody's an immigrant in one way or another.
Correct. But what I'm getting at here is this immigrant mindset where we're a family, we're tied together, and we're going to do this together. North America is very individualistic, right? It's like, you have your own nuclear family. A lot of people, they count down to age 18 and they kick their kids out of the home. I don't think that's going to work for the future. I think that we may actually have to revert to an older mindset, which is, this is my family and I have to look after them beyond age 18 or beyond age 25 when they graduate. This is a more of a long-term thing financially. So that's one approach, Daryl. And I guess it might be funny to hear this, but I grew up in a household with my grandparents. So did my wife, and I'm very proud to say that my children are growing up in a household with their grandparents living in it too. And it's worked for us as a family unit, but also the byproduct of that is it's also worked for us financially as well.
Well, of course.
Right? And I think this may be something that people need to consider.
Well, I tell people, because they're staying at home much longer than, before you try and go buy your first house and you're, maybe by the time you're hitting 30, whatever the case might be, an average. But they are staying longer. And I tell the parents, I said, they should be paying, even if they don't pay you rent, you should be collecting rent.
Right.
And putting it into a trust account for them that's accumulating money. Because, if they don't have that money, chances are years, if they're paying you $700 a month or $1,000 a month, they're going to have some good equity that they're going to be able to buy something. And parents need to realize, everything they own, they can't take with them. They're going to die, and a lot of people that had houses for 20 and 30 years, they bought their houses for $300,000. Today their house is worth $2.5 million. They have a lot of equity. Those people wouldn't even know what to do with that money for the rest of their life. So they should start, whether it be in a loan or their inheritance that they're giving to the kids now, and help them 10 times better if they give it to them when alive.
I love where your mind is there, because I'm seeing this in my practice daily. Okay, so let me ask the guys who are here listening here this question. The question is this: would you prefer 250 grand at age 30, or $1 million from your parents when you're age 65? Which of those two options would you prefer? Would you like the money when you're younger or older?
Even if you're online, if you want to ask that question.
Younger, right? Everybody would like it younger, because we know that money in our hands could leverage to that $1 million plus. That would allow us.
Well, way more than that.
Correct.
Way more than that in fact. If you had 250 when you're 30, what could you make that by the time you're 65?
Well, by 60. So exactly. So I'm going to get there. So let's say you got that 250 in your hands. You use that to go and buy $1 million property, okay? And then that property compounds every 15 years. It goes from $1 million to 2 million to 4 million to 8 million. You'd be in a position of 8 million at that age bracket, rather than the $1 million that your parents were going to hold on and gift to you upon death. Okay, and so Daryl, I mentioned earlier we're going into the estate plan business. I'm not an estate planner, but we're having a lot of conversations about exactly what you're talking about, which is the conversation of early inheritance. Okay, guys, let me ask you: who owns real estate in New York City? It's not first-time home buyers. Right?
No,
it's people who
been there for a long time.
Correct. Intergenerational wealth is what we're talking about. I've been talking about this in Canada for about 10 years. And I think people are finally starting to listen to me, right?
Well, a lot of people are, because they see, like, they go, it's all they got to do is go back the last few years. They've seen 2021, 22, the market just go like this. And there's very, very, very few local people that can keep up that pace. That's why they put on the foreign people that the foreigners can't buy, because we can't compete with the foreigners. They come from these other countries. They have a small apartment. They sell it for $4 million. They get $4 million of equity to come in here, and they can go buy something where the local person has only got a little bit of money, so they price them right out of the market.
So look, we're an international city, and if we want to be said in the same sentence as New York and London, then we have to deal with the same issues that come with being an international city, which means that we're not just dealing with people who've lived here for generations. We're dealing with new money, right? And there's a lot to be said on both sides of that conversation, right? But no matter how much you want to talk about it, it doesn't change the reality that we're dealing with house prices where they are. And just going back to your point, Daryl, the transition of wealth prior to death is a conversation that you should be having with your clients right now. If you've got clients in their 40s, 50s, 60s, 70s, these are the people who are going to have to gift some of their wealth to their children. Because if anybody's owned real estate in Ontario for the last 10 years, they've won the lottery.
And even longer, because you go back to the people, if you think of the baby boomers, they've had these properties for 30 years.
Yep.
They were buying these properties at $300,000. And like I say, these properties, if you're in Toronto, it's $2.5 million. York Region, still probably running about $2 million, right? So they have a lot of equity. Like I said, and they're 70 or 85 or 75. They're not going to ever, they probably made some other little savings.
Yep.
They're not going to be able to spend that money anymore.
Correct. And the thing is, guys, you can't, this is a funny saying, but you can't eat equity. So you're living in a $2 million house, but you're on CPP and OAS, right? That's not a way to live either. So I'll give you a really good case study where we helped an older person and we helped their children at the same time. So are you familiar with the reverse mortgage product? Okay.
We don't use it much. It started to come in.
Yep.
And then I didn't hear too much about it. Mm-hmm. But I can see it starting to come back in again as the population gets older.
You've got it, and the equity's there.
Yes.
Right? The equity's growing.
Right.
So I'll give you a quick summary of the reverse mortgage, guys. So reverse mortgage is one where you can take a mortgage from the bank, but the bank does not require you to make a monthly payment. Okay. Instead, what happens is if you borrowed $100,000 at the start of the year, you might end the year with a mortgage owing of say $107,000. Okay, so your mortgage actually grows. So you look at that on the face value and you go, that's not a good thing, and this product is not for everybody, to be clear. Okay, but I'll give you this example. So we've got a lady, she's in her 70s. Her daughter is in her 40s. They're married with a child, and the daughter is ready to buy their first home. Okay, they've been renting up until now. But when they look at the market, where can the daughter buy based on their down payment and their income? They can buy maybe an hour and a half away from where the mother is, the grandmother is, the older lady. So understanding this situation and looking at all the pieces on the chessboard, I say, then we spoke to the older lady and said, look, you have the ability to access some equity from your home, which you can then gift to your daughter. Because of that, your daughter can now buy a property that's closer to where you are, and then you get to keep your family together, you get to see your grandkids, right? And so it was utilization of the family wealth in a way that not just served people financially, but also served their life, right? They actually created the ability to keep the family together, keep them closer together.
And even the parents didn't have to leave. They
Correct.
stayed in their house.
Correct. The parents stayed in their house, right? They don't have a monthly payment, okay? And when they looked at, what is the money in this house for? It's for my children, right? So why wait until 20 years from now when I'm gone? Why not?
And you don't get to see the enjoyment or share the enjoyment with them.
Correct.
Right?
And you get to see the legacy that you've created after saving and working so hard in your life. So it's a product that, Daryl, you mentioned earlier, it's increased in utilization by 40% in the last 2 years for the very reason that we're discussing here. Equity is there, but equity isn't helpful unless we can convert it into something meaningful, be it cash flow or down payment or those things that help the family.
So think of this, guys. We deal with a lot of people that their families have a fair amount of equity. They don't even realize how much equity they really have. And, the kids are talking about helping them out, help do financing for them, get through it, and manage it, other than just lose it and lose all that equity to the builder, right?
Oh, right. This with this particular situation.
Yeah.
last
So
month.
so there's so many doors, and if you don't look at all the doors, you only see one way. Like, look here, 1 door, 2 doors, 3 doors, 4 doors, right? So most people just try the conventional way of getting a mortgage, but there's so many other answers. You got to go searching and do preparation. So if you start with young families on that, sometimes maybe it's good to get the families involved and show them the other ways that how they can help out, right? Because they have no clue. I mean, zero. So having that other options. So how does one go about in finance? Because most people really don't know about reverse mortgages.
Yep.
They hear a little bit just there, but they really have no understanding on it. So let's say I have a property. I'm in North York. I have no mortgage. The property is easily worth $2.5 million.
Right.
Right?
Yep.
And I've got a little bit of savings. I don't have a lot of savings. So I could go get a reverse mortgage. How much of a reverse mortgage could I get on my house and give to my kids?
Okay, so this is interesting. Reverse mortgages, the traditional reverse mortgage is only available to people aged 55 or older. I don't know if you qualify now.
I qualify. I'm sorry to say I qualify, but that's okay. So that could be like 10 years. If you take 100,000 a year.
You could take it 100 grand a year and turn it into like an income stream. Yes, you could do it that way. You could take a lump sum, or you could even do it monthly. You could say, I want $1,000 a month or $5,000 a month to live your life, right? So in the same instance, and I should have mentioned this earlier when I mentioned this lady who was helping the kid and give them 300 grand, we also were able to set them up with an income stream for themselves so that they're able to basically draw a monthly income to sort of assist them with their, because they're only on OPP and CPP and OAS.
Yeah, well, that's what I'm
right?
saying. They got no income anymore.
Exactly. So there's a way to live a better life when you're older and simultaneously help your family by maybe.
And you're not even
giving
leaving
them
your
some
house
equity.
at that point.
And you get to stay in your home, right? The majority, guys, everybody's living longer as well, right? With the medical advancements we've had mean people are going to be living longer. This also creates a supply problem, meaning those houses which traditionally would have come onto the market when people were 75 are not coming onto the market until they turn 85, right? But and knowing all of this, that's creating the problem for their own children because people of their demographic aren't moving on to the aged care facilities that they used to, right? So,
well, the funny thing is, so the government just in Toronto right now, I think it was, when did we do that thing, on Thursday? Friday. So the first day of vacancy tax in Toronto started on Friday. So if your house is vacant for any more than 6 months, they can charge you 3% extra onto your taxes. So we were having our sellers sign off to say, it's either rented or owned or whatever the case might be. Otherwise, there's going to be a 3% surtax. So, some of these people have a place here and they have a place, say, Florida or Arizona, Mexico, whatever.
right.
So they're better off to start with that reverse mortgage on it or even let the kids live in it, right, for some of that duration so you don't get taxed all that money.
Yeah, I mean, the reverse mortgage is a very interesting estate planning tool as well, because if you're able to gift some of those funds to your children in advance, there's some connections with probate, and this is where, again, as real estate professionals, going forward, you can't just be salespeople. Okay, you have to be the expert in the realm of real estate for your clients, And that means, you have to know a little bit about mortgages. You have to know a little bit about estate planning. Okay, you need to know a little bit about transactions with the law, drawing up wills, those types of things. You don't need to do these things. You need to have people on your team.
Collaboration, guys. Collaboration, collaboration, collaboration.
And we have to be an extension of your team, right? I've been in scenarios where, and I'm sure if you've been in real estate long enough, you would know this too. You get to the week of closing and you end up dealing with a lawyer who isn't seeing things from your side of the table, and they're trying to make your life hell, and they ruin the final end of the transaction, and it leaves the client feeling in a bad place, and it ruins the experience, right? And the same with mortgages. I think the word here is ego, Daryl. Our industry has a lot of egos, right? Lawyers, financial planners, accountants, and what needs to happen is before the proverbial hits the fan, that you have a good relationship, a good working relationship with that lawyer, with that accountant, so that when we need to make these tough decisions,
you're not butting heads.
We're all on the same side of the table. Right?
How many times as realtors have we had to pass it on to a lawyer on lawyer's approval or something like that, and it's a perfectly tight situation, and they want to change 60% of what you've done? You know that, right? So, that's why you want to be in collaboration, that you and your lawyer or your mortgage broker are sort of on the same wavelength in how you operate. Because, he'll tell him one thing and I'm going to tell him another thing. And the client's going to be like this. We're going to be looking at like each other like this, right? So we're not solving anything. So that's why it's so important to find someone that you feel that you can mesh with, do business with, because, it's becoming that much more difficulty with rules and regulations. Trust has now come into effect. How commissions will be charged and collected is going to be a major factor. So we have to have preparation for all of this. And the best way to prepare is today. It may not be there today, but if you start planning for it today, you can have answers for it tomorrow. So, Napoleon, can you get him a glass of water for me, please? So what happens is that planning, if you got a young couple, sit down with them and figure out where they're going to get the finance, what their answers are, especially if they're buying new buildings and stuff like that. They're buying them on spec. If you look on right now on the assignments, there's so many good deals on assignments. So I'm telling people, go dive in. There's not a better time to dive into some assignments right now, because someone might have paid 1.2 for it 2 years ago. You can pick it up for $900 today, right? Lots of good deals like that are $100,000 less. They bought it at the peak. The market has changed. So someone's going to do it. Why as well be you?
Yeah, I'm on many email lists, as you can imagine, and I am getting emailed these what look like spectacular deals, and I would also say, though, they're mostly for the end user, right? A lot of these deals now, let's say that one there, it wouldn't work as an investment property.
No,
you wouldn't get the rent that would cover the.
No, you couldn't get the rent. End user.
But yeah, if you're an end user, now's the time to start looking in the market, and those opportunities, unfortunately, are going to for the people who originally bought them. Unfortunately, a lot of these people aren't going to be able to qualify. They're going to lose out. I'm sure you've seen the same, people walking away from tens of thousands, hundreds of thousands of dollars on deposit, right, and letting those properties come back onto the market.
Well, and the builders are not letting you walk. I'm telling you right now. So we have one when Sonia comes back, I won't even say the address, but it's downtown in Yorkville. The people paid $1.419 for a 589 square foot condo, no parking, no locker. Now it's Yorkville, the hottest spot.
Sure.
$2,400 a square foot.
Yeah.
They paid. And right now there's assignments on it for 1,000 square feet. They can pick up for $1.4.
Wow. So
right?
$1,400. So a full $1,000 per square foot drop.
Yes.
In value.
Yes.
That's
right.
Crazy. Yeah.
So, and now I have to try to find a way, and that we can help them not have a crash landing, right? because how I see it, they could easily lose $300,000 or $400,000.
So we just navigated a situation like this for a client, a realtor actually, purchased downtown.
Realtors love to invest, baby.
Hey, you know
especially
what?
when they think they get lots of money.
But this person was caught up in the frenzy of a couple of years ago.
Of course.
Bought at 1,500 a square foot. The minute I saw the listing, I said, this is going to appraise short, and unfortunately it did. It appraised for about 100 grand less. But, and this is interesting, this was an older lady, older realtor, and we accessed a reverse mortgage on her family home in order to create that extra down payment so that she could close on that deal. And yeah, it's a thing for her grandkids for the future. So yeah, she knows she's lost in the short term, but she's holding on to it for the long term, so it works for her.
Guys, very, very you can go through the storm today and wait 10 years, you're going to have a shitload of equity, right? So it's just going through that. And I remember when I bought my first house. I mean, I was working so many extra hours and doing other odd jobs to make money before I could get my mortgage down that I could afford this place, right?
Right.
So that's when you need it the most. Because once you bought your first place, chances are you've built some equity. So it's a lot easier the second time round. But it's the first time people that are caught up to here, because they thought they were going to have lower rates. They thought if worse comes to worse, they could sell it for a profit. And really, they still can sell it for a profit. That property, I think realistically, could sell for 1.2 to 1.3.
Okay.
So so if we can help them finance, they'll make a bit of a profit and they'll get out of it.
Right.
So that's what we're looking at. I got to go look at it this week and just give my final stamp on it. But by what I hear and check out, if they're got the help in the financing, they'll be able to close it and then sell it.
And what you're talking about there is specialized financing. And I will tell you, Daryl, in the last 2 years, we've been in that world more so than in the previous 15. Okay.
Combined.
Correct. Meaning that we get these outside-the-box questions and problems every day, and it's really like, how are we going to make this work? And I said it earlier, it's like everybody who comes to me, it's like they've got some chess pieces on the chessboard, and our job is to try and figure out how to play these pieces. And sometimes we have to go get more pieces, meaning we got to get family, or we got to get outside help, and we got to work with the builder to extend the closing time, and all of these things, right?
Well, that's what I think I'm going to have to do. I think I'm going to have to work with the builder number one.
Yep.
Right, because they still have units, and this was 3 years ago, and they still have units they're selling. They figured if they didn't have any to sell, it would be a lot easier. But unfortunately, they still have units to sell. So, hopefully they can work with us, extend or lend us or borrow something that, they're not going to be caught with so much, because I don't see any other way that.
Yep, I've seen a builder just this year give a client a 90% first mortgage, even though they wouldn't qualify with a major bank. And the builder chose that as the lesser of the two evils, because if they didn't,
he was going to take it over, have to go chase after them,
and then
resell it.
Correct. Yeah. So we're seeing builders, some of them understanding the economics and saying, okay, it is what it is. Let's see what we can do to help these people. Right?
Hey, there isn't anyone, if you look at the overall picture compared to when we were in the peak compared to now, it's if they bought in that peak, they're not selling in the peak market today. The market's changed. And that's why as realtors and mortgage brokers and bankers and lawyers, we have to help educate them and get them to understand that. So is this the best time for you to be selling? Right? Maybe if you hold on to it for another year, it might
first probable drop. Yeah.
So see, a lot of people are just thinking that they're going to drop. They're going to hold, and that'll be, what, the 5th time?
No, well, if we look at it, I look at it in terms of months. So I think it'll be the 5th meeting where they hold.
Yes.
But we'll be going into the 9th or 10th month of no change.
Right. So what that builds up is it builds a lot of confidence in the marketplace, because the biggest question I always had from people, what do you think, what do you think, what do you think about mortgage rates? And my answer was always to them, they're going to stabilize. And so I think we've got to that stabilization period, and the Bank of Canada doesn't want to drop the rates too fast because they don't want to run on the market again like we just had. And if they dropped it 2 or 3 points all at once, chances are there'd be a run of all that pent-up demand. So they want to move it slowly. I only think between 1 and 1.5% for the year.
Yeah, so, I mean, I think 1.5 is probably the most optimistic.
Yeah.
And, you know, guys, when it went up in jumps of like 0.5% or a full percent, right? When it comes down, please don't expect that, right? It wouldn't be a good thing for the market because things will get crazy as well. It's going to step down at about 0.25%. I can't imagine it stepping down much faster
No,
than
that's
that.
how they'll build it. Quarter point.
So that would mean that we need 4 Bank of Canada meetings where they decide 0.25 point at each meeting for us to drop a full point. And if we don't drop in March, then the likelihood is we're probably only going to, best case scenario will be 1% by the end of the year.
Yeah.
Right?
That's what I'm saying. 1 to 1.5 at the very outset.
But what do you think, Daryl? What do you think's going to happen when the Bank of Canada drops by 0.25? What will happen to the market in your experience?
Well, the beautiful thing is it's people getting confidence, and even to be able to qualify, because no matter what, you know, with the mortgage stress rules, this is what really hurts. You know, I went back to the 22 years because real estate was at its lowest in 22 years last year in sales.
Yep.
So the mortgage rates were identical, basically, what they are today. The difference is they didn't have the mortgage stress rules, and the prices were only $225,000 versus $1.185,000.
Yeah.
So they're the two biggest differences, right? So that's the things that they overcome. Most people, once they get a fixed rate and get in there, they can adjust their payments. They'll scratch and save whatever to pay it, but it's that first initial with all the costs that you got to pay. You know, moving into a place, there's costs, there's land transfer costs, there's the lawyer costs, right? Sometimes you got to maybe get a bigger mortgage, whatever. So it's all happened to you within that first year. So if they can make it through that first year, they'll generally make it through the duration. You don't see a lot of powers of sales because the banks have renegotiated with a lot of these people that were in very high probability of going power sale. The bank is not in the purpose of taking homes over. So what they've done is they've negotiated with them for longer term amortization. So if they had a 25-year amortization, they would give them a 35 or 40-year amortization, and they were paying really no principal, just, you know, penalty.
Well, and it's better than selling and then having to go rent.
And
right?
so it's the same for the owners. They get to stay in their house. The payments are exactly the same. For the banks, they're not owning the houses and it's not crashing the market. So that part I was quite happy that they could resolve that issue by doing it that way, right? But, you know, if you're going to play pickleball with them and be difficult, they'll be forced to take the house, right? So we're at 2:04. We've gone into the hour. So I had a lot more questions, but I would like to see if there's anyone here in the audience that would like to have a question for Dion. Come on, Igor. Ask us a question. Right?
Hello, thank you for giving us all this amazing information. You mentioned that right now, to borrow $100,000 is about $600 per month payment. And is that based on your credit? Is that based on your income? Or how did you get to that number? Or is that just like a general for the industry?
Yeah, so I picked a middle of the road interest rate there, which is around the 6.5% thereabouts. And that's translated to around $600 to $650 a month in payment. As interest rates drop, this will obviously augment to the positive. If we put this in the context of a couple of years ago, $100,000 cost you $375 a month. Okay, so that's the difference that we've seen. Affordability, and this is why you've seen this absolute halt in standstill for quite a while.
So just do the numbers: $375,000 or $375
dollars a month, yeah,
to $650,
somewhere in that range, yeah.
right? So almost double. So you imagine then you add another 400 or 500, 600,000 onto that, right? That's what the mortgage people were paying. So they were paying, say, $3,070 or whatever, and now their payments are up around $6,000 and $7,000. Not too many families can afford that, right? So it's why it's been a very tough scope for a lot of different people, because running down to $3,000 up to $6,000, big difference.
Yeah, and just to answer the other part, credit does play a factor in the interest rates that you are offered. And if your credit is not fantastic, as you probably know, in the world of lending, we have A lending, B lending, and private lending. And the further along the spectrum you go, the higher those rates are. So if A lending's at 6%, B lending's at around 7 or 7.5%, private lending's at probably around 9 plus.
10.
Yeah, and then B and private also come with fees. So it's not just the interest rate, but it's at least 1 or 2 extra points in fees. And you know what, Daryl?
I want you to explain that, because a lot of people don't understand that. So you go to Dion, you can get traditional financing. His company is going to go look for the best rates for you, the best terms for you. So that's an A lender. Then then you're a B client. You're going to have, that means the risk for the financial is a little higher. So they're going to charge you a little higher fee. So they're not going to get you that 6 or 5.75. It might be 7 or 7.25. But then if you're a high risk lender, then they got to go to a B lender, and they're going to charge a premium maybe of 10%. But on top of that, that mortgage broker, so let's say I was going to take a $600,000 mortgage. What would be my penalty fee that a mortgage broker would charge me to get that roughly?
Okay, so if we're going from A to B, okay, with a B lender, let's say we've gone from 6% to roughly 7.5%. That's the interest rate, okay? In addition to that, there'll be a lender fee payable to the institution, which will generally be 1%.
And that'll go onto your mortgage.
Actually, the B lenders deduct that from the advance.
Yes,
right?
yes.
So if you want a $600,000 mortgage, I'm going to have to borrow you
600 and
right?
606,
example,
yes,
right?
bingo.
Correct. So just be aware that those lenders charge interest rate and a lender fee. This is standard.
And how would you say $6,000?
In this case, 1% would translate
1%,
to
$6,000. So that's, you're on the next level. You go to the next level up,
right.
you're probably going to double up again on that.
So
It'd be $12,000.
We'll go from a 7.5% interest rate, probably starting at 9s, okay? If you got a higher loan to value, then you're looking at 10, 12 plus fees. And those fees aren't going to be 1%. In most cases, they'll be 2 to 3%, okay? And this is where, and it's funny to say this, Daryl, some of my clients who used to be A lenders, because of the stress test, because of affordability, have been pushed to B lending. And some of these who are B lenders have been pushed to private lending just because of the landscape we're in. And the crazy thing is I'm seeing very good people with good borrowing character being pushed to private lending, okay? And it's just the numbers, right? The government have implemented these strict regulations with these institutions, both A and B. It used to be the case as a mortgage broker that, if we didn't qualify for A, that's okay, B will be our backup. It's not true now, right? B has their own strict guidelines imposed on them by the regulators. So if you're not A, you may not be B, and you're likely private.
And that big...
Right, and these are the conversations we have to have with our realtors and our clients to say, hey, here are these are the expectations we have to set for you. And, if you're not in a perfect situation, we need to talk about the reality that you might be on that side of the fence right now.
That was one of the questions I was going to ask. How do you see the current challenges in the real estate market affecting mortgage acquisition for new and existing homeowners?
Yeah.
That's it right in a nutshell right there. So if they're going to go get a mortgage, you need to try and get your credit score and that in check as much as possible, because the penalties today are like, I remember paying some penalties.
When you say penalties, you mean the lender fees?
Yeah, the lender fees,
imposed
the
by
lender
lender,
fees.
right?
I call them penalties, but lender fees. So that's over and above of the mortgage amount that you're borrowing. So like you said, if you're borrowing 600, you'd have to borrow 606, and the 6,000 would go and pay that mortgage broker $6,000 right up front. And it gets worse. If you were a C lender, you're going to pay 12, 15, 17, 18,000, right? Up front. So, you know, you're chasing right from the very beginning for the home ownership, right?
And look, guys, these lenders have a place, right? Our goal is to get you and your clients the absolute best rate possible. But I'll give you an example, Daryl. I've got a friend of mine who's a realtor. Maybe about 10 years ago, we started helping him buy investment property. Realtors, as you know, you make income, but you've got good accountants, and that income gets halved when it goes to the CRA. So the number I had to work with is lower. So we had to take him to a B lender, and he had to pay those higher rates, and he had to pay those fees. But because he was open to buying and making those numbers work for him, he now has a portfolio of 9 properties. As his career built, in many cases, right?
Well,
we
if
have
you look at rents, you know, rents went up 30, 35%, right? Now, the good thing is rents are on the way back down again. You know, if you're looking for rental, your clients are looking for rental, the rental prices are actually coming down again, if anyone's really paying attention. So, you know, and like I say, with vacancy now, the people that would keep their place vacant, what the government's trying to do is force them into renting them out, right? So that's one of the angles that they're working on, that these places will become available for rent. Now, a lot of people don't, on your primary residence, don't, you know, you get tenants in there, you can't get them out. And we're going through that with a number of our clients right now, that it's a nightmare with some of these tenants that, you know, they don't leave the place in good shape, or if they're in there, they don't want to leave, right? Unless you're going to be the end user. So, you know, if it's your principal residence and you lived in, you know, nice piece. I mean, I've had the same thing. My house has all been just me and not renting. So I wouldn't want to rent it either. But that's what they're trying to force upon us, that, you know, with the vacancy taxes, that they've got to rent it out to get an income or get somebody in there, that they're not getting hit.
And, you know, I think that's fair with the housing. Look, guys, we have a housing crisis. This is not just a shortage. This is a crisis. And if we've got houses that are sitting vacant, which could be providing housing to Canadians who can rent them, then I believe that we should make them available.
Well, if you go downtown and you look at some of the condos, right, because a lot of the condos were bought by investors, look at nighttime.
Yeah, how many lights are on?
You're seeing 30% vacancy.
Yeah.
Right? So this is going to open up a lot more rentals. So it will bring the rental stream down dramatically. So that's the good thing about that, you know. So for every bad thing, there's something good that may replace it. So what is that silver lining that we're looking for, right? Anyone else have a question they would ask Dion here? Mia, come on up here to the microphone.
Okay.
So I have a question, because you know how they had the first-time home buyer incentive from the CMHC, and they're discontinuing it as of March 20-something or whatever. Yeah. Are there any lenders available that still work similar to that for first-time home buyers? Because for people who don't have the family support system to be able to borrow equity from.
Yeah, I hear what you're saying. So yeah, good question. So this is a program, guys, that was brought about, feels like 3 to 4 years ago, where if you had, say, 5% down, the government would effectively match you with another 5% down. So it'd help you with a down payment, okay? The challenge was that the price point of those properties was very low, $500,000 or less, and there was some income qualifying where it couldn't be more than 4 times the value of your yearly income. long story short, we looked at it and we never utilized it. It was one of the worst programs ever rolled out by CMHC. It was pretty much useless. I don't know of any mortgage broker who actually successfully used it for their clients. Okay. But to the next question, what's available for those who don't have the family support? And this now goes back to just sort of the traditional savings, work on your credit, work on your income. And the challenge there is, I know that the average GTA income does not buy the average GTA home, okay? And so what I have been seeing is I've been seeing people team up. Brother and a sister came to me. Each of them wanted to live by themselves. 450 grand max is what we could get them. We're like, hey guys, you got to buy together, right? So we put them together. They bought the 900K house. They rent the basement as well, so they're actually way better off. And it's going to take this sort of outside-the-box thinking now for those people. Like, just so you know, when I first started in mortgages in Canada, I was at Victoria Park and Shepherd. And if you draw a...
That's Victoria Park and Lawrence.
Okay. But Victoria Park and Shepherd's a little different. If you draw a 5-kilometer circle around Vic Park and Shepherd, what you see is a catchment of new immigrants, blue-collar, working-class people. Back then, 15 years ago, guys, people walked into my office making 35 to 40 grand a year. I was able to help them buy a house. It was amazing, right? They were buying houses, townhouses, condos for 200 to 300 grand back then. And those same people live in a house today worth 1 million plus, okay? And the income that they would need to qualify to buy the own house, the same house they live in, would be 200 grand, okay? And the challenge is that we get, say, the same demographic coming in. They're not earning 35, but they're not earning 200. They're earning maybe 55 to 60 in the same blue-collar positions, right? And there's no way they can buy that property in that same location. And here I'm talking about Scarborough, Malvern, and those locations, right? So what we're seeing is people really having to pair up with family. Sometimes it's friends. Yep, I'm seeing
even
this
just
happen.
people they know somewhere they're joined.
Correct.
Right?
And if parents aren't able and or willing to help, then we're having to go down that path. And I just want to say this, Daryl, you touched on it earlier, where these older people can't get their head around the fact that, my children need my help, right? And we have to really explain to them that not only has the game changed, but the playing field and the game has changed, right? We've got prices up 3 times over the last 10 to 15 years. We've got the stress test come in. We've got interest rates up double, and the ability to qualify is diminished significantly. Yeah. And so sometimes it's not that the parents are not willing to help. It's sometimes that they need to be spoken to in a way that they can understand the landscape today. And what me and our staff do is we often jump on a Zoom call with the client, their parents, and their realtor. And we sit down and we explain the numbers. And once they see the numbers, they go, I get it now. I understand why my children need my help. Okay, so how do we make it happen?
Because they think they're lazy. See, parents never were given anything from their parents in most instances. They didn't have anything to give. Now, so some of them just feel, you know what, we did it on our own, let them do it on their own. And really, they have big equity, and they, obviously, we come with nothing in this world, we're going to leave with nothing in this world. Everything is borrowed. So they might as well give, like I say, some of them now where they have a good relationship, and they can even have a better relationship. And that's why someone like you or me having a conversation with those parents and get them to understand, how hard it is for the kids. They're not kids. They're like, it'll be 35, 40,
yeah.
Right? Are having a hard time qualifying to get a mortgage unless you go to Timbuktu. I grew up in Toronto. Then we went to North York. And then I bought my first place in Thornhill. And then I'm in Richmond Hill. But each time I came north, I built my custom house here in Richmond Hill. The cop built it here. I was going to build it here, but it cost me double at that time.
Right.
So, people just sort of went a little north. You don't always want to go north, east, or west. Since COVID's happened, it's the biggest migration out of the city in history. All the outlying burbs right across Canada have increased in price value. So before even there, you could go retirement and go buy a place for 150, 200,000.
Yep.
So
outside.
now they're even costing you 300,000. So or more,
Yeah.
right? Depends where you're going. So those outlying areas where you were going to go and retire now, their prices have come up quite a bit. So it's like having a noose around your neck sometimes. So we have a question here. So
Yeah.
from Nicholas. Nicholas is one of our young new agents here. Will rates drop back down for the long term, or will they drop temporarily and rise again? Have we really seen the full impact of some of the inflationary policies adopted during COVID? For example, the U.S. Fed Reserve printing 80% of all U.S. dollars in circulation in just a single year, 2020, right?
Okay.
So a lot of money was printed up
Yeah.
in the last few years since COVID.
So think about this.
Their
guys.
presses were going pretty. They were printing all the Canadian and U.S. Treasury money. They were doing pretty good.
So I'll put that in the Canadian context, which is, imagine in your wallet right now you have $100, okay? 40 of that $100 in your wallet didn't exist prior to 2019. It didn't exist in the economy, okay? So 40% of all the dollars that exist in Canada today were printed into existence from 2020 onwards. And that was due to CERB and CEBA effectively making sure that the economy didn't fall apart. It was a necessary evil. Okay. Do you know how much house prices increased between 2020 and 2022? 40%.
Yes. The same amount of money they made.
Coincidence? It's not a coincidence, okay? It's because that money had to find a place, okay? The people who got the CEBA money realized, hey, I'm doing better than I thought. I didn't lose my job. The world didn't end. What do I do with this? Let me go and invest, okay? And so you saw property prices jump by 40% over a 2-year period, okay? Now, in the year that followed, we saw it drop by 20%,
Yes.
okay? And so now we've sort of stabilized at around there. Now, this is a multifaceted question, so let me read here. So will they drop and then rise again? This is the question about interest rates in Canada. I think that the purpose of these interest rate increases that we saw over the last couple of years was to get inflation under control.
They want to get us down to 2%.
Correct. That's the goal, right? Inflation, guys, we wanted at 2%. For the years prior to 2020, inflation was hovering at anywhere from sort of 0.5% to 2.5%. We were in the strike range that the government feels comfortable. Does anybody remember what the peak of inflation was when we got all the way to the max in a couple of years ago? It was 8.1%, okay? It went crazy. And
most of that was on mortgages.
Housing,
Most of it is on gas.
Right.
And then food.
Correct. Yes. All related. And so the question then is, so we've done enough. It's clear now that inflation is last report was 2.9%. Okay, so we're down significantly. The Bank of Canada has changed their language. So it's not just what they do, it's what they say that you need to watch at these Bank of Canada meetings. And what they said at the last meeting was the conversation is no longer about how high we need to take rates. It's when should we be dropping these rates. Okay, that's where the Bank of Canada is mentally right now. To answer this question, it's an inflation question. As long as inflation remains within the comfortable zone of less than 3 and closer to 2%, I can't imagine interest rates increasing. No, I don't think we've seen all the effects of these interest rate increases yet. That was part of the question. Because when a decision is made to increase interest rates, you don't see it the next month. You see it generally within the next 18 months. And some of those interest rate increases, which we saw last year, have only been 7, 8, maybe 10 months. So we may not see the effects of those for another couple of months. I can't imagine it increasing unless some external world event.
Like major, major. Right, yeah. So rates are probably going to, and I say 2025, I believe the rates will come down again another 1.5%.
Yeah, right? And again, it's all going to do with that inflation number. But I'll just say this, guys. We got to a point where you could borrow money for 5 years at less than 2%, fixed. Please don't imagine that that's a reality that we will have in the next couple of years. Benjamin Tao, one of the more respected economists, is saying that the Bank of Canada rate that he expects is 3%. That's not the retail rate. That's the Bank of Canada rate, okay? Which means at the retail level, that's probably closer to 4, okay? So 4 may be the new normal at which we are borrowing 5-year money. I hope it's less, but if I'm making plans, I'm making them on 4%, and that's the way you should be sort of probably talking with your clients. Yeah.
Any questions, girls or guys?
Yeah, we got
Nick,
one.
come on up.
Hey, Dion.
Hey there.
Thanks again for all the info.
Yeah, you're welcome.
Very, very informative, definitely. Three-legged question, I guess.
Okay.
One is rule of thumb: 5 times your salary. Does that still
4.5
exist?
is the better number now. Okay?
4.5. Okay.
So I'll just, for those of you in the room,
Yep.
you used to be able to borrow easily 5 times income. You make 100 grand, you can borrow 500 grand, probably, right? Now it's closer to 4.5. If you've got better credit, it'll be 5. If you've got a car payment, drop 100 grand, right? Remember that number, right? So that's really
100 for the car.
Yeah.
okay.
Second question regarding the reverse mortgage. I'm assuming it's the chip mortgage that we referred to in the past, or
Yeah, so
something
that-
similar.
Correct. So the chip
Mike.
mortgage is the one that's been around the longest.
Yeah.
It's offered by Home Equity Bank, and they're one of several lenders now. So the reason that many of you haven't heard or utilized the reverse mortgage, I think, is that because there was pretty much a monopoly in Canada for a long time. Now with competition, you get more competitive rates. Okay.
Right.
Also, I just want to be clear here, we've got very strict government regulation, which are protecting seniors, which means that in the United States, these types of mortgages have a bad name for a good reason, because people went underwater. These banks were racking up interest beyond the value of the asset, right? So people went bankrupt, right?
yeah.
That hasn't ever happened in Canada, and they've put in place regulations so that it will never happen, where it will never exceed the value of your home. But yeah, there are actually four players that we work with right now in the world of reverse mortgage.
And obviously, there's a premium to this program.
Yeah, so you're probably, let's say if you're borrowing at, say, a major retail branch today at 6%, you're probably borrowing at 7.5% for
Right.
a reverse mortgage, somewhere in that range. Yeah.
Okay. And last question, I think I forgot. Self-declared income, like Home Trust used to do. Does that exist anywhere, or?
Yeah, great question. This is an important question for realtors, right, in particular. So self-declared income, guys, is, well, it could mean many things. There used to be a time where I give you a piece of paper and you wrote how much money you made on it, and I would take that to the bank. Imagine that. Imagine just sort of getting a mortgage that way, right? That disappeared many, many years ago. With the B lenders, they still require some level of proof of business income or some kind of income, okay? So let's say I have a realtor, they made 200 grand last year. They went to their accountant found all these expenses, so on paper they made 80 grand. If I go to a major bank, I can only use the 80 grand. If I go to a B lender, they'll look at the 200, they'll say, what industry is this person in? Let's say it's real estate sales. We'll say, okay, well, there's probably going to be a car expense, a phone expense. So they might take off 20 grand off the 200. So I can use 180 declared income, self-declared income, with a B lender versus 80 grand with an A lender. And that's how we help people with B lending.
Okay. Fair enough. Thanks for all the info.
Thanks, Nick. So, guys, the time is 2:28. We're going to wrap it up. Does one last question before we close up the shop here? Anyway, if there's not, I want to thank Dion for an incredible day today. Listen, there's so much, when someone has so much knowledge that they can share with you, we're only hitting the tip of the iceberg in an hour and a half.
It's true.
Because you can just extract so much more. So, Dion, where could they reach you at? Tell them where they can reach you at.
Yeah, so my website, kangamortgage.ca. On Instagram, I'm at the Dion Beg. And I'd encourage, especially the professionals in the room here, to follow, because every week I send out between 10 and 15 one-minute videos that talk about the market specifically, talk about case studies that relate to your business. So that would be a useful resource for anybody here.
So I need to get on that mailing list.
No, you certainly do, yeah.
Right.
Oh, actually, and I'll say this too, Daryl, and you know this, but I do live webinars about every quarter where you realtors can invite your clients to attend. I speak to them about what's going on, how the mortgage world works, why they should consider buying. We get them pre-qualified and we hand them back to you. So we help.
But where are
them,
you going to be when you speak to them?
wherever the sun is shining.
So, no, the only reason I asked that, because I would like us to do a first-time home seminar
Okay.
for invite the public or the clients, whoever.
Yeah.
And, I would like someone of your caliber there to answer the questions for these,
Oh, I'd love
especially on
yeah.
mortgages.
We could certainly
Right.
talk about that. But
Right.
but separate and in addition to that, I want you to all know that this month, March 26th, which is a Tuesday, we're doing this live webinar, and I'll tell you more about it off screen. But I provide you with the pre-written ads. I'll give you 5 or 6 ads. You copy paste, you send out, and our business, it grows by helping real estate agents create deals. So if you work with us, our goal is to help you create deals that you didn't even know existed in your own database by talking to people in such a way that we move them to action in real estate. So yeah, be happy to help anybody.
Okay, good. So we're going to plan on having a first-time home seminar in here for the public and clients and friends and whatever. Or if it's a bigger group, I might have to get an outside hall and do it like maybe the Persian Palace, whatever, because we can hold more people there. But, I want to thank you. Again, this is Daryl King sharing with the Mindsets. With Dion Beg from Kanga Mortgages. We just had a great session here. Let's have a big applause here, everybody. Everybody that's in the audience on Zoom, I hope you enjoyed today. And if you'd like to get a copy of this, DM us and we'd be happy to share it to you. So we're going to be signing off. Till next time, Daryl King sharing the Mindsets. I hope this was helpful for you. Take care and bye-bye.